Hey everybody, it's Brad and Greg from Ranch Capital Advisors. Hello, Brad.
Fantastic Thursday to you, Greg.
Fantastic Thursday to you too, sir.
Thank you so much. Man, is it getting expensive out there. I tell you what.
Prices.
I went to the store today and what cost me $5 6 weeks ago now cost me $55.
Yes.
I'm talking about some massive amounts of inflation.
You know what that's called? That's called inflation.
Is it?
Yes. And
Holy
you know what?
cow.
I'm glad you brought that up because that is going to be the subject of this episode today is inflation. And it's a big thing we hear in the news all the time.
Every
right?
day, all day. It's the hot topic besides cryptocurrencies.
Yes. Inflation and cryptocurrency is the two things that they bounce back and forth with. So what is inflation? How does it affect you? Like, what's all the fuss about? We're going to be going over that in this episode today. So first of all is what is inflation? So inflation is a sustained rise in prices. And the Fed's job is always trying to kind of do a delicate balance of inflation. They want the economy to be moving along, to be growing, but they don't want it to be growing too hot. So moderate inflation is considered good, right? And so the Fed's goal is to have about 2% increases in prices, 2%. And we've been actually running short of that for the last decade a little bit. So
Long time.
Yeah.
Very
So
long
he's
time.
made it very clear that they want inflation to tick up and hope that it's kind of settles back down into 2%.
Whether it's going to be a transitory period of inflation as the Fed seems to think it will, or if this is the dawn of some form of hyperinflation, which we have not seen in a very long time, probably since the late 70s.
Right. Yeah. So hyperinflation would be defined as, bad. And then there's stagflation and deflation, lots of different inflations out there. So the Fed has kind of
like inflation mania,
So the Fed has a very difficult time of you're never going to get it just right. I mean, they do their best. It's a difficult thing to do. It's a large economy, lots of moving parts. But they certainly have an influence on inflation because of the way that they can control interest rates. When they keep interest rates down, it encourages lending. It puts more money supply into the system. You're also getting trillions of dollars from the government. That's also putting more money in the system, which is why you're seeing prices go up, especially because of COVID. Certain areas are going up much more.
The growth of money supply has been so large, over the last year that it has, outgained the growth of economics. So the money supply is very well ahead. And because of what we've seen with COVID shutdowns, there's a number of areas that have fallen behind that need to get back to full speed.
Right. Yeah, the balance, where we would normally spend money on different areas and travel, it really got shifted, right? When we couldn't travel, we couldn't do certain things, so we spend more money on groceries, right? We couldn't go out to the restaurants as much. So there's been a kind of kink in the system, if you will, where people are spending more in certain areas, and you're seeing prices go up, and you're seeing companies not having enough supply to actually fulfill on a lot of the demand. And that's what causes prices to go up. There's really two types of inflation. You have what's called a cost push inflation, where it's really not an increase in demand. It's just an increase in the cost of that supply, kind of like back in the 70s when they had that gas crisis, right? Is
the oil embargoes?
Yep. Yeah, you paid attention in the history class. Good job, Brad.
Yeah, back then, third, fourth grade, if that.
Yeah.
Well, no, it wasn't even that. It was like pre-K.
Yeah.
But hey, we sat in a
time,
lot of lines trying to get gas to get me over to, my 10 a.m. preschool class.
Yes. Yeah. You remember doing that with your mom?
Driving in the Pinto, I tell you. Glad no one rear-ended us.
Yeah. So when there's a shortage of a supply in something, that can push prices up. And then on the other hand, you have a demand pull inflation, where there's just so much demand for something that it gives the suppliers really the go-ahead to increase prices, and then that just starts spilling into different areas of all over the economy, which ends up pushing prices higher. So people are worried about it, whether prices are going to go too high, and then we're not going to have enough economic growth to keep up with it. And then they're worried that the Fed will start really tightening interest rates, which for right now, they said that they have no intention of doing until sometime probably later 2022. Now, once the Fed starts tightening, that's why you see the market sometimes sell off when people are worried about the Fed tightening, because usually when the Fed starts to tighten, it does cause some volatility in the stock market, but most of it is actually short term, right? I mean,
correct. Anything these days in the market is short term. You can consider somewhat what we're seeing like a rogue wave, where you will have a big dip or a big rise, and then an opposite move in the other direction of equal strength or equal weakness. So we saw such a decrease last year because of the shutdowns in a number of different areas, and the pullback that we saw in inflation. And now we're kind of seeing that same opposite reaction, but in the different direction,
right?
You know, kind of an inverse reaction, the opposite wave of the down wave. So,
right.
You know, that's keeping in mind that we think this period is going to be a transitory period because of the issues that are facing us now from the shutdowns that we had before. Hopefully supply is going to be able to uptick and get back equal with demand.
Well, I think like the coronavirus, like people really thought, all right, we're shutting down building, our products, our inventory, and then boom, it just got released, and it's hard to. I mean, if you're in the pool business or computers, I mean, everything is just back ordered. So you have this huge demand, and people are actually making more money than they were pre-COVID, and the average household net worth is up. So that was kind of like a perfect storm of like a big increase in demand, and then the companies weren't prepared for that. What sectors have actually done the best historically?
Well, if you look just from an inflation standpoint, it's rather interesting because just about every sector has done well during the, there's basically 5 periods of inflation that we go back to right before the start of the tech bubble in 1998 that we've gone through. They're not very long periods, but the winners have been technology, energy, real estate, utilities, and industrials have been the 5 top sectors on average, especially tech and energy. They've been large outperformers. But on the other side, when we look at what we have sector wise when there's a rate increase or we're in a rate increasing environment, again, looking at the last 4 rate increases, which go back to 94, last 4 periods of rate increases, on average, every sector does pretty well.
Yeah.
Technology again, real estate again, energy again, utilities, and healthcare. Some of those are defensive, but some of them aren't. So it's really a mixed bag, and the market in general, usually hangs around that 8%, 7-8%.
I think
annual
it's usually
return.
like always a sharp sell off initially, and then it rebounds. And so I think a lot of this, is more of just fear-based type of news, headline news. And unless we have this hyperinflation that occurs and you don't have any growth to back it up, where that is just not the case today. We have great growth. We're going to continue to have great growth. The Fed will likely start raising interest rates, and certainly the markets will respond negatively at first. But if you don't panic, if you buy more through it, I think you're going to be rewarded for this.
Well, one example is technology, because you can see as inflation has picked up really since things started to lift in August, a lot of the technology stocks have flatlined to a point. Use Amazon as an example. It has not, gone really past its peak that it had last August, as the yield on the 10-year has increased. But when we do our research on a lot of these companies and we look into depth on what they're saying in earnings, like Cisco yesterday, I mean, Cisco had really nice earnings, but they have given a lower outlook because they don't have the supplies they need to meet the demand that they have at this point in time. So you have that bottleneck of, just component parts that needs to get moving, so that the shortage that we're seeing in certain areas of the tech market, especially with the semiconductors, that demand can be met.
Right.
So the weakness in technology from our research shouldn't really be there. It's been the best outperformer in inflation and rising rate.
Do you think a 0.5% raise in 10-year treasuries is going to affect Amazon? I mean, come on.
No,
My wife's still going to order from there every day, and earnings are still going to continue to be well. I don't see, they just have this cloud of like, interest rates moved a 0.25%, or 1/8%. Tech sells off, and the underlying fundamentals are great. These companies are dominating. So I say, use it as an opportunity. And when everybody else is scared, that's the opportunity that you take advantage of.
All the smart people out there, especially the people on TV, I mean, they always want to be able to offer listeners something new, and things are not going to change. There may be slight variances here and there, but for the most part, history is going to repeat itself in regards to the areas of the market that do better based on inflation and based on increases in interest rates. There will be some issue with liquidity coming out of the market, but that's an entirely different story for a different time.
Well, who does get hurt in inflationary environments are, people that keep money in the banks, right? Because if inflation is running at 3% and you're making 0.25%, if you're lucky, you're quietly losing money. Bond investors can get hurt as well. Actually, stocks are the best way to deal with inflation, and because companies can raise their prices. And so as long as you're on the ownership side of that, and you'll feel it on the consumer side, but if you're an owner of that business by owning some stock, you're going to benefit as well from those rising prices that your company is going to be charging. So stocks are still the best way. Dividend stocks also that are raising their dividends every year. That way you're getting an increase in your income. So to me, it all just spells stay long stocks, and really just goes along what we've been saying, that we are in the middle of a great secular bull market. There will be some bumps along the way, but it's a great time to be an investor, and stocks are a great way to really deal with inflation.
That's well put, because
thank you, Brad.
That's what we do every single day,
That's
right, Greg? So. The thing remains that there's always going to be worry out there, no matter what it is, whether it's inflation, changes with inside the Federal Reserve, wars in the Middle East, the price of commodities. Just as long as these issues are not long term, that's why we think it's transitory. Once a supply chain starts to move again, and it's much easier for productivity, which our productivity still has a lot of slack in it, and we have a long way to go as far as making up and getting back to the levels of productivity that we were pre-pandemic. Usually in inflation-based cycles, you're seeing productivity decrease. So there's a lot inside of the numbers right now that point to, this is going to be a short-term issue. I mean, it may stay elevated, but it's not going to be runaway. Is going to be a short-term issue that once the mechanism of, the global economy is able to, come up and meet demand, things will start to even out.
Okay. So the bottom line is don't let inflation scare you off. Stocks are going to be the best way to deal with inflation. Make sure that we're owning companies that have the ability to raise prices, which we certainly do. And if things are going to cost more, they always do, but as long as you're outpacing inflation, then you're going to be in good shape. But if you stick all your money in banks and bonds, it's going to be a little bit tougher to achieve that. So if we can help you in any way, please let us know. We're happy to meet with you anytime. So thank you so much for watching, and we'll see you next time. God bless.
Take care.